Once again, a very good morning to one and all. We are all set to begin the second technical session. I welcome you all to the second technical session on the sub-theme Capital Market Reforms with our Sustainable Economy. Capital markets are vital for economic prosperity, channeling savings into productive, socially and environmentally responsible investments. The capital market regulator SEBI is spearheading reforms to foster transparency, investor confidence and sustainability through ESG mandate, BRSR reporting, social stock exchanges and green finance initiatives. Recent amendments to SEBI LODR regulations have further reinforced corporate governance and standardized ESG disclosures. This session will explore how these capital market reforms redefine corporate expectations and emphasize the crucial role of company secretaries in positioning governance practices with long-term economic and environmental objectives. Ladies and gentlemen, with this background, I now invite our learned panelist, Sri Manan Lahoti, Partner and Head of Capital Markets Practice, Cyril Amarchand Mangaldas. Let's have a big round of applause. Dr. Dinesh Soni, Group Head Compliance, Nuama, and former Managing Director and CEO, NSE Administration and Supervision Limited. CS Dr. K.S. Ravichandran, Practicing Company Secretary, Coimbatore, and our moderator, CS B. Narasimhan, immediate former President and Council Member of the ICSI, for the second technical session on capital market reforms vis-a-vis sustainable economy. The second technical session on capital market reforms vis-a-vis sustainable economy. Would now request CSB Narasimhan, immediate former president, to please welcome Sri Manan Lahoti, partner and head of capital markets practice, Cyril Amarchand Mangaldas, by presenting him a planter. Sri Manan Lahoti leads the capital markets practice at Cyril Amarchand Mangaldas and is qualified to practice in India, England and Wales. With over 20 years of experience, he has led high-profile domestic and international capital market deals, including IPOs for ICICI Prudential, AMC, PhonePe, Grow, Zomato, Swiggy, and Adani Wilmar. He's renowned for his expertise in securities law, pre-IPO structuring and governance. Thank you, sir. Would now request CSB Narasimhan to please welcome Dr. Dinesh Soni, Group Head Compliance, Ruama, and former Managing Director and CEO, NSE Administration and Supervision Limited, by presenting him a planter. Sri Dinesh Soni is a Group Head, Compliance at Nuama Wealth Management Limited. Would now request CS Ranjit Pandey ji also to be on the stage, please. We'll have the planter presented by Ranjit Pandey ji as well. I was about to call his name, sorry. Ranjit Pandey ji, please, let's have a big round, ladies and gentlemen. Dr. KSR is a founder and managing partner of KSR and Co-Company Secretaries LLP, Bangalore and Chennai. With deep experience in the company and securities and foreign exchange laws, he advises on governance, compliance, restructuring, and insolvency. He has authored several acclaimed books, written over 1,000 articles, and appeared before key regulatory authorities and tribunals. He is a former Indian Air Force specialist and has also served as independent director at Karur Vysya Bank. I now request, thank you Ranjit ji. I now request CSB Narasimhan, our moderator, to please take over the session ahead. Thank you.
A very good morning to esteemed guests, invitees, speakers of the session, delegates present here with us as well as those connecting virtually. For the second technical session on day 2 of the 53rd National Convention of Company Secretaries on the sub-theme Capital Markets Reforms Vis-a-vis a Sustainable Economy. I am very pleased to welcome the esteemed speakers for this session. They are the panelists for the day. Dr. Dinesh Soni, Group Head, Compliance, Nuvoma, and former Managing Director and CEO, NSE Administration and Supervision Limited. Mr. Manan Lahoti, Partner and Head of Capital Markets of Cyril Amarchand Mangal Dash. And then finally, our own KSR, Dr. KSR, Practicing Company Secretary from Coimbatore. Let's give a round of applause to all the three panelists, please. Capital market is the backbone of a thriving economy, mobilizing savings, fueling productive investments, and driving sustainable growth by channeling capital into environmentally and socially responsible enterprises. Sustainability in capital market means integrating long-term ESG consideration into business practices, investment strategies, and overall working of the company apart from corporate governance. This is essential for addressing global challenges like climate change, resource depletion, and social inequality. By aligning financial flows with these principles, the capital market can drive responsible growth and ensure lasting value creation. Recognizing the need for sustainable growth, SEBI is advancing a unified agenda to enhance capital integrity, boost investor confidence, and embed sustainability across the financial ecosystem. Though tech-driven reforms, streamlined compliances, ESG and BSR mandates, strong push for green and sustainable finance, and ESG-focused funds, SEBI is shaping a transparent, stable, and innovation-ready capital market. SEBI has amended various regulations for benefit of investors and stakeholders through measures like harmonizing the SEBI ICDR and SEBI LODR regulation, ESG initiatives, emergence of social stock exchange, launch of financial products like green bonds, etc., to provide capital for environmentally and socially beneficial projects. Recent SEBI LODR amendments have strengthened corporate governance in ESG disclosure to standardized reporting and tighter compliances. Collectively, these reforms are transforming capital market by integrating sustainability, technology, and innovation to build a growth-oriented financial ecosystem. This theme holds particular significance for company secretaries who play a vital role in navigating capital market reforms and integrating sustainable practices within the corporate governance framework. They ensure that sustainability becomes a fundamental business value that drives long-term success. In this session, we will explore how capital market reforms are reshaping expectations from corporate India. We will also discuss the vital role of company secretaries in aligning these reforms with long-term capital creation and stakeholder trust. The deliberation will enrich our understanding of how regulatory reforms, market dynamics, and the role of company secretaries converge to advance long-term economic and environmental goals. Against this backdrop, I warmly invite our esteemed speakers to discuss the transformative role of capital market reforms in fostering a sustainable economy and the strategic role of company secretaries in this journey. I would now request each one of the panelists to share their insight and perspectives, and I mean generally make sure that we are in time. The time limit is given as about 5 to 7 minutes. So first I invite Dr. Dinesh Soni to give his views, please.
Good morning, everyone. I thank the Institute for inviting me to this technical session. It's really honor to be amongst all of you today. And tremendous cultural program yesterday we had. And I think I must congratulate you that even after attending such a strenuous program yesterday, all dance and all, you are in time for the morning session on a Saturday. So this topic of capital reforms and sustainable economy, I think I would try to cover the aspect which is very critical and close to my heart is governance. There are some aspects while as a company secretary you are day to day involved in so many compliance aspects across the financial sector, banking and all other related field. I would try to cover some aspects where I had a very long experience. I had a long stint at NS in regulatory department. So starting from the governance of the market infrastructure institution, that is exchanges, clearing corporations and depositories. What has happened during last 10 years, there has been a very on-ground supervision, a very intense supervision over these MIIs, because what has resulted into this is ultimately investor protection. Because without investor protection, we can't have a sustainable capital markets, because that is the investor is a fulcrum of the entire capital markets. In the last around 10 years, there has been significant changes in the way supervision activity of the exchanges, on the depositories, on the clearing corporation. That is the reason we have moved away from 1.5 crore investors registered around 10 years before, and now in 2025, we are more than 12 crores. This has been the most sustainable part of the entire ecosystem, because without investors coming either directly or through mutual funds, these are a very critical part of the entire system. So I think we must credit ourselves, the entire ecosystem. There should be a really patting on the back of all of us, because of the reason that ecosystem has performed. That is the reason there has been a tremendous increase, whether it is SIPs, it is monthly SIPs, or it is participation directly through the exchanges. One more aspect I would like to lay emphasis is the surveillance capability of the exchanges and the use of technology. Like another governance aspect is how we are in a position to function when a very critical times come. So we have capability to shift to, with the help of technology, shift to, within 45 minutes we can shift over disaster recovery thing. This also was not there 10 years before. So I think there has been such significant changes which has helped to bring in investor protection. Another aspect is, which as an investor you may not come to know, is the significant changes which have come up in the broking side of the thing. Now, India is perhaps the only jurisdiction when an investor trades, the information flows from a trading member to clearing member to the clearing corporation. So clearing corporation has an eye that a single investor who has traded to any broker, what is the security and what are the funds given as a margin. And that is also checked from the information available through the bank. So there is such intense scrutiny and use of technology that governance has increased, and investor protection is at the best level, I would say, in the last existence of the capital markets. And this is the most sustainable aspect which will help the capital markets grow in all the industries. So these are the opening remarks. Thank you.
Hello. Yeah. May I now request Dr. Manan Lohoti to give his views, please.
Hi, good morning, everyone. Thank you for this opportunity. I'll try to keep this this part of my remarks very short. I'll probably, during the course of the next 1 hour, give more practical insights as a capital markets lawyer, how I see ESG, sustainability, and similar conversations evolve. I have been a practitioner for about 25 years. When I started my first IPO, I think it was Maruti Udyog IPO 23, 24 years ago. Around that time, and it's not about Maruti alone, it's about all the IPOs around that time. We never ever discussed, or I don't even think we were aware of a term called ESG. You would start to make an offer document, do deep diligence, think about what investors want to see, think about what the regulator wants to see. ESG was not a conversation of relevance then. I kind of compare this to, when I was growing up, firecrackers in Diwali was just fine. We never stopped ourselves. We did not know the more evolved, views on environment that time. But today, the awareness for fireworks, even if we have still enough of fireworks, unfortunately, but we are all a lot more aware. Similarly, sustainability is part of every discussion in any deal-making room. Today, we can't think of doing an IPO without having a very strong discussion on what the company's philosophy is. Forget the framework that SEBI has to make a disclosure. Forget, the other tax incentives around it. Simply speaking, today, capital markets transactions in India are large enough. We market those IPOs in India, but we market those IPOs outside India. Through this cross-border, nature of this of IPO transactions, we are bringing into India the expectations of foreign investors on matters of sustainability. There are a lot of funds, less in India, but more outside India, who cannot today participate in an IPO or invest in a company unless and until they understand enough about the sustainability score of the company. And when I say sustainability score, I don't mean to say ESG rating under any regulation, but broadly speaking, they want to know more and more about what you do. That said, while we've come a long way in the last 20 years, from no conversation to a lot of conversations today, there exists areas where we can focus a little bit more. We should discuss some of those later in the day today and later in the session today. But I just want to leave you all with a thought that for us today, sustainability is not only about BRSR, about environment, about transparency, about integrity, but also about the entire capital markets itself. And so we will discuss what can disrupt the markets in a short to a medium term, what kind of companies, what segment of the market. So we'll talk about the sustainability of capital markets itself. And of course, we will discuss some nuances on what SEBI has been doing over the last few years. Very quickly, there was a very different world until the CSR came out as a mandatory requirement in 2013. So the journey before that and the journey after that is of course very different and exciting for us to see. So I'll just leave you all with the thought that sustainability from a capital market standpoint means a lot more than just the BRSR standards that all of you are experts on and I'm not. But I'll speak about a little bit more on how capital markets lawyers, investors, regulators, and participants look at this topic. Thank you.
Thank you. Now can I request our own KSR to give his viewpoints on the matter.
Very good morning to everyone. My dear beloved President, Sri Dhananjay Shuklaji, very respected Central Council members, past presidents, and my friend and beloved B. Narasimhan sir, a veteran in the capital markets area. Before I start, I need to wish on this Kerala Piravi Day. എല്ലാവർക്കും ഈ കേരള പിറവി ഡേയുടെ ആശംസകൾ. The Kerala state was formed, I can say, with British Malabar, Kasargod, Kochi, Travancore. ഇത്ര പ്രദേശങ്ങളും കൂട്ടിച്ചേർത്തതാണ് നമ്മുടെ കേരള സംസ്ഥാനം. I mean, all these things were put together to bring out a state. And for the information of the dignitaries on the dais and off the dais, Kerala state is the first state in India to approve a ESG policy for the state. That is the beauty. I have no hesitation to say that sustainability is in the heartbeat of Kerala, the people of Kerala. Sustainability is in the heartbeat of people of Kerala. Look at the population estimates. UNDP has said 2062, 175 crores. This is the reason for thoughtfully our institute bringing out a subject on capital market reforms vis-a-vis sustainable economy. Because we are confronted with digitalization, process automation, AI intervention, and therefore we need to see a balance between what growth are we going to achieve. Is it sustainable? What kind of population we are going to have in the next 30, 35 years? We are going to leave a dependable population of more than 85, 90 crores, I am telling you, in 2062. More than. One side you see less than 14 years, another side you see people like us more than 60, and in 2062 we are all going to live because of advancement in healthcare and technology. Therefore, we are going to have a dependable population, which yesterday the special guest, Malabar Gold, the chairman MP Ahmed was saying, grandma program. Look at the conceptually how we are thinking. Look at the sustainable economy's reason for that. And therefore, I would like to start saying, congratulating ICSI for bringing out such a thought-provoking topic for the panel discussion here with eminent faculties in front of you. In my opinion, capital market reforms must be driving towards a sustainable economy, and that depends on A, investor protection. ICSI works there. Investor protection. B, investment protection. Capital flow from anywhere must be flowing into the stream of production, and enabling regulations and reformist regulations, transformational regulations are required. Number 2 is society must be protected. To what extent are our practices? You remember the principles of corporate governance issued by MCA in 2011. Just apply mind on that. This is a very important hallmark of sustainability, and reforms must provide for that. Reforms must be outcome-based reforms. In an investigation, inquiry, inspection, or any other proceeding, outcome-based approach is not supposed to be there. You cannot say, I want to fasten liability on him and proceed my investigation towards that. Outcome-based investigation is not allowed, but outcome-based reforms towards sustainability is the need of the hour. I'll give you just 3 illustrations, which I always say. Volkswagen, the National Green Tribunal said, listen to these quotable quotes, it will be a paradox to say what will be unethical elsewhere will be ethical in India. किससे बात कर रहे हो statement यार? What will be unethical in rest of the world will be ethical in India. You can't think that. Tolerance to pollution in India cannot be higher than what is elsewhere. Tolerance to pollution in India cannot be higher than what is elsewhere. Look at these words. And polluter pays principle cannot be allowed. You just pollute, you just harm the society, you just do anything and then just pay a penalty for that. Coming to penalty, let me give you another illustration. Volkswagen, I said, now I will go to Johnson & Johnson. You know what? 1st July 2021, J&J reports to Securities Exchange Commission. Here is $2.5 billion. Original court in the First Circuit, $4.7 billion. Reduced by the Missouri Court of Appeal to 2.1. Supreme Court rejects it. SEC reporting 1st June 2021, take this $2.5 billion because 2.1 billion plus interest thereon is 2.5. This is what NGT said in for Volkswagen case. Polluter pays principle cannot apply. You cannot do the harm to the society, pay the penalty and run away. Therefore, capital market reforms are required to be tailor-made for achieving sustainable economy. Third example I will give you, Luckin Coffee, Delaware court. You know what? $600 million they raised through the capital market. Let me give you a beautiful position of valuation in 2018, July. What is the Luckin Coffee? 2018, July, $1 million. 2018, November, $2.2 billion. 2019, April, $2.9 billion. 2019 IPO, May, $600 million raised, valuation is $3.9 billion, $3.9 billion. I have given you illustrations because illustrations make us understand the illustrious nature of the topic that we are. I am looking forward to interacting with you more on this. Thank you very much.
Thanks, KSR. I think we have done a wonderful, quick summarization of what the speakers intend to harp upon. One important thing which tickles my brain is what KSR was mentioning about investor protection, the very important framework on which the regulator is working on, and simultaneously has also touched upon investment protection. In my view, I have always maintained this. Investment protection is not in the hands of the regulator, but in the hands of the Almighty. That's what I need to say. Well, having said this, let me also share some quick questions with the panelists for their response. And my first question, if I may be permitted to ask Mr. This has come from one of the participants, and therefore I intend to ask that question to Mr. Dinesh Soni here. Can you give an insight on what tech-driven transformation are likely to emerge, and how can companies proactively adapt to ensure compliance, safeguard investor interests, and align with sustainability goals? How would you advise the company secretaries to be prepared for this transformation? Come as a surprise, right?
So bit of actually echo.
Yeah,
So,
go ahead.
Yeah. So can I have it from the or anyway?
You want the question back? Okay.
Yeah.
I'll repeat. I think I'll repeat it. Can you give an insight on what tech-driven transformation are likely to emerge, and how can companies proactively adapt to ensure compliance, safeguard investor interests, align it with sustainability goals? How would you advise company secretaries to be prepared for this transformation?
Yeah, thanks, Nasiman. I think in terms of after the BRSA reporting which has commenced, and I was just going through the NSE and SCS report on the comparison between the various norms which have been reported for the last 2-3 years. So this was a report done for the top 200 listed companies. So I think the figures and all which are seems to be very encouraging. Why? Because there is at least I think I would say ESG is a long-term goal, and it is for the country, it is work in progress. For the entire ecosystem, we can't say that we will reach this particular destination in a X time. In the passing phases where we are in, when reporting has commenced, and where there is a entire globe is working towards environment, social and governance factors, this would progress gradually, and I think regulatory intention has clear-cut emerged. By there has been a very proactive role coming from the regulator, while the reporting to some may feel onerous, but I think overall for the ecosystem, for the investor, for our market, I think when we say that we want to reach soon the top 3 economy of the world, we need to have this sustainable practice. So message to the company secretary would be, I think we have seen, I have been a part of myself into a lot of reporting system which have been put in for the intermediaries. I think without the use of technology, there would be significant, I would, in case I can call errors, or there could be missteps. They could be unintentional as well. Many times it is not a error which has happened because of cautiously. Without, in case we are not using the technology in the regular reporting or the proper frameworks, then we are going to definitely miss. My single message would be to have best resources available and best kind of thing which the reporting to the regulator happens well. This is my thought.
Thank you. I don't want to counter you on that. Let me take up a question for Manan. The question is, you have led some of the India's most prominent IPOs. Your firm, I think they have done a documentation for most of the IPOs. Given your experience, how are issuers responding to the increasing demand for sustainability-linked disclosures? And are these reforms reshaping deal structures or investor roadshows in any meaningful way?
Thank you, Mr. Narasimhan. There are, I'm getting a little theoretical about it, but there are broadly 2 or 3 ways in which rule making or expectation making can happen in the world of law. Some regulators follow principle basis rules. They tell you this is where we need to go, you find your own way to go there. And there are some regulators who are more specific, this is what I need, and this is in my view the best way to reach there. But there's a third layer, which is market driven, which is the most effective. If you want to raise capital, you don't only think about what SEBI wants, you actually think about what the investor wants. If you can't sell your IPO, there is no IPO. Where we are seeing the transition happen, like I said at the start, was that 10, 20 years back, we were not discussing ESG. And I'm just abbreviating it to call ESG. There are a number of whatever related conversations as part of when I say ESG. But now they are. And the reasons why we include some disclosures in the offer document on ESG is not because SEBI requires us. We do not need to comply with BRSR, for example, even the core at this point of time in an IPO document. But the reason we include the disclosures that we do is because investors ask us those questions. Now, there's a bit of a gap, and I'm going to quickly talk about this. If you see the offer document, it could be DRHP, RHP, prospectus, could be 600 pages. Maybe ESG disclosures are literally half a page to 3/4 of a page. Does not get enough significance. But when you go to meet an investor in a roadshow, you take 20 to 30 slides. You don't take 600 pages of document. Within those 20 slides, you will probably have 1 or 2 slides dedicated to ESG. Very clearly underlining the point that more than SEBI, it is the investor who's asking us the questions. So when we make a document for the investor, which is the roadshow deck, we include more. But if you think about what we do after listing, top 1,000 companies are required to now follow BRSR core assurances. That's a lot more information than what we on our own, because of market, include either in the slides or in the early stage offer documents. So there's a bit of a gap, I still feel, when the regulator makes regulations thinking that this is what is needed for the investors versus what investors need versus eventually what is the compliance burden on the companies. So the deal making has changed without a doubt. And I would say for me, the reference point is a number 2 document, which is roadshow slide deck. That is what the market needs today. We should focus on that as a center point for making regulations.
Thanks, Manan. I think that's a fairly well made statement. I'm sure the audience would have, our participants would have loved it. Now let me have a question for our own KSR. Ms. KSR, how in your opinion SEBI BRSR framework has streamlined sustainability disclosures for listed companies? What, according to you, are the benefits which corporates are deriving out of the enhanced disclosures and how has this contributed in driving responsible investment practices in India?
In my analysis, the SEBI has been following a principle-based as well as prescriptive approach. Prescriptive approach is very good in order to bring out certain data points, certain numbers, certain indicators. Principle-based approach brings out the leadership elements, reputation building elements, investor confidence building elements. As a combination of both P and P, that is principle based as well as prescriptive, SEBI has achieved an excellent thing, because at the same time from 2015 to today, I have also studied what Securities Exchange Commission proposals are and what conversations were there in around the topic of ESG and sustainability. And I have found that we have gone way ahead in terms of these sustainability capital market reforms. In terms of stewardship code, in terms of BRSR, in terms of ESG ratings, in terms of ESG funds, in terms of green bonds. For example, International Capital Markets Association principles are already borrowed and refined here. So overall, I feel SEBI has done a wonderful job, which are of course basically drawn from the 2011 MCA voluntary guidelines containing those 9 principles. So I see a bright future in terms of regulatory, I can say, articulation of what is required, tempering of what is required, because policies and regulations are the 2 pillars for the conduct to be developed. For example, BRSR reports and the various data points, as a board, when I sit there in the board of directors and look at those data points, I am able to apply mind. Application of thought is the beginning of everything. Thereafter, the thoughts are formulated into strategies, plan of action, and thereafter you see the result. Therefore, I see today the reporting requirement brings to the board of directors an awareness of the touch points, data points, pain points, and the sustainability, what they have to do to achieve that. Thank you, Narasimhan.
Thanks, Ravi. Now let me have a question for Dinesh. At the United Nations Climate Summit in Glasgow in 2021, COP26, India announced that it would achieve net zero by 2070. Since then, the regulators have undertaken pivotal initiatives to achieve the targets, considering India's multifaceted ESG evolution and greenwashing on the contrary. How do you envision the ESG reporting landscape in India in the coming years? In fact, I also recall having read a small article which said that we are far below the target which we wanted to achieve, we have set for ourselves to achieve. So that's a very important point. What can be done to further ensure that we are able to move on better than what we have performed so far?
So I feel globally, in case we see Indian jurisdiction, we are far ahead in terms of what the regulator has implemented, the reporting systems. So this, like KSR mentioned, what has it resulted on the ground is when these discussions would happen at every company board, there is going to be focus on the ground on the company's activity, whether it is environment, social or governance. This is going to gradually improve the standards what we have, coupled with the CSR thing. And I would see another aspect which we have to remind ourselves is that, being a parent to kids, I have seen that our generation, which is next generation, has been academically, there has been a government policy to inculcate environment from the class 1 in various subjects. What it has resulted is the general citizens are much aware of the requirement to keep the environmental aspect better. So this is, the society is kind of ready to contribute in a different manner, because it is being taught from the entry level and it is goes up to the academics, this EVS subject is, I think it has also contributed. So the society response plus the board response, the institutional response, regulatory aspect would, I think, improve the, but it will be a gradual process. I don't think it is going to make a change in a very short or couple of years, but over the years it will be very instrumental. Like say what we would be saying in 2035 would be very different from what we are seeing now.
Thanks, Dinesh. Now let me pass on a question to Mr. Manan. The Social Stock Exchange was established based on the FM's 2019-20 budget speech. How far do you think the same has been effective, considering the success rate in other countries, and how would you advise the company secretaries on underlying opportunities and possibilities as a social auditor? Let me also tell you, we have formally got recognition from SEBI to be a social auditor, social impact assessor. Instead of the word auditor, they have changed it to social impact assessor. Over to you, Manan.
Thank you, Mr. Narasimhan. So social stock exchange globally is a new concept. And anything which is so new will take its own time. It requires a lot of changes to ecosystem, to mindset, to tax treatment. And I'll start with the ecosystem first. Actually, before I go to the ecosystem, so it has obviously, social stock exchange has met some degree of relevance now. I think 80, 90, not-for-profit organizations have registered with NSE, BSE. About 30 or 20 of them have in fact raised some capital also. And the way it works is there is something called a ZC, ZP, which is you don't get any return and you don't get any principal back. So zero coupon, zero principal instruments are created. And they are essentially not meant to be traded. They are just meant to be donations. Now, the size of the raise has been small for 2-3 important reasons. One, this lack of awareness. How many of us in the room make donations and charity every year? I would say most of us, if not all of us. How many of us go to social stock exchange to see who's come out with what proposal and how can I contribute? So even category of people who is making donations is not aware of what are the opportunities there. Linked to that is also the tax part. Today it is not very clear whether it is part of CSR 135. The idea is it should be. There's a proposal for that, in fact. So that should definitely help on creating more sort of not only awareness but also a better channel. The second reason why is not taken off so much is lack of corporate participation. Corporates have their own established channels for making CSR and other donations. They haven't so far thought about how they can utilize this SSE to at least allocate part of their capital. They need to start doing some of that. Third is, this is capital markets, right? It's meant to be capitalist, if I can be blunt. The financial intermediaries, merchant bankers, brokers, your wealth managers, they're all thinking about better returns. Returns, unfortunately, in their mind are financial in nature, not social. So there's a bit of a mismatch between, the NPO, the not-for-profit organizations, the philanthropies, the financial intermediaries, and SEBI is trying to put all of them together. Setting the mindset in the same way for everyone will take time. We definitely need some tax incentives, some clarity on whether this is going to be a CSR or not. And more than anything else, somebody needs to spend money in marketing it. These organizations are very small. They are not for profit. At times they're raising as little as 2 crores. They don't have the budget to go and market this product. Here, I think, a lot of regulators need to come together. A lot of industry bodies need to come together to market this platform. And as you get deeper into understanding of it, you will also see that it is a platform which has been created by a capital markets regulator whose focus all these years has been to protect investors. In real sense, SSC is not for investors, it is for donors. So you're not looking back, you're not looking to get any return. So your offer document should not look like an investment offer document. That said, you have to avoid misuse. You should not create an opportunity for somebody to say something and do nothing about it. So balancing the regulations, reducing the cost, making it more marketable, making it more aware, creating tax incentives, and trying to see how philanthropies and the corporates can use this platform in future.
Thanks, Manan. I think that's explained wonderfully well. But let me also tell you, when the concept of social stock exchange came about, there was a lot of euphoria created amongst the professionals that we're getting a new opportunity. So many of them wrote the examination, got themselves registered as social auditor. But hardly, I don't know, in the last count, possibly about 10 to 12 entities have gone through the process of getting themselves listed on social stock exchange. As Manan put it, the money invested in for a social stock exchange or in a proposal which has come before that is more of a donation. There's an element of philanthropy in each one of us. And that's what is being exploited by the government in terms of, and that is for the common good. And that is where we said we will do it. And more importantly, please don't take it to heart, but many of the intermediaries, many of the professionals who were associated with getting the social stock exchange listed, they have done it pro bono. In other words, they don't get paid for what they do. It is more of an experience what is gained by them. Let me have a question for Arun KSR. What are your insights on how is India advancing in adopting sustainable investment instruments, driving environmental stewardship, keeping in view the target of zero emission by 2070, and what role can, according to you, professionals play in this journey?
Firstly, in talking about 2070, I am of the view that it is not important that we achieve 2070 in a target-based approach. We have to achieve what is possible, what is sustainable, and there shall be no tolerance, that is zero tolerance, in respect of any of the representations turning out to be not true. That is more important than anything else. And automatically, when you are talking about zero tolerance on frauds and misrepresentations, unfair trade practices, etc., sustainability is automatically the achieving the output. Therefore, enhanced investor protection, number one. Enhanced governance standards, number two. Removal of information asymmetry as well as information misrepresentation, number three. And the disclosures, enhanced disclosures, specific disclosures, that will become the foundation for bringing investments. We also have to see at this point of time two green things. One is green, another is not green. One is green, that is, we should be able to look at how green financing can be strengthened, to what extent it can be brought, it can be induced, it can be enhanced. The other green, which is non-green, is, for example, if you look at the whole of the securities laws and regulations, we have no unified ESG disclosure regime. We don't have a definition of greenwashing. Therefore, this is two things we have to build into that. Therefore, non-green, styled as green, shall not be allowed. This will definitely, in my opinion, help you to achieve a sustainable investment practices, which means the instruments which are going to be tailor-made, customized, structured, are going to be sustainable investment instruments. Thank you, Mr. Narsi.
Thanks. I think that's very important. I mean, green bonds, but there has always been a concept of what is known as greenwashing. So under the guise of a bond being issued for this purpose, the money is raised without the objective being achieved. Well, I've had two questions each. I think before I open up the questions to the audience, so the participants to raise, I'll have one common question for all the three, which I have coined myself. Now, I've been interacting with the regulators on a regular basis, and one thing which was told to me, which is very disturbing, is the fact that the company secretaries, or at least the BRSR report, seems to be a verbatim reproduction of what has been said by some other company. Now that's where it's a worrisome for us. And they were contemplating, I know there's going to be happening soon, that concept of assessment, impact assessment. That is whatever is stated, how far has it realized the objective for which it was done, or for which it was stated. Now that is likely to be done, and we have been pitching in with the regulator at every opportune moment that whenever it is going to be done, please keep in mind the professionals like company secretaries in practice for doing it. Now, having said this, my question is this: how do you relish, or how do you accept this proposal? What is happening, and what do you feel? I mean, whether impact assessment itself will at least find some kind of a solace for the companies practicing in a proper manner. My first question, the same question I'm going to repeat to all three. So this BRSR reproduction is what's happening, that's the concern. And how can you prevent it? What can be done? Like, one is impact assessment. How do you look at any other suggestions from your side on this? First, I'll start with KSR.
Basically, we always consider company secretaries or driving force in terms of ensuring fair practices, enhanced disclosures, non-discrimination in flow of information, real-time flow of information unless there is some unpublished price-sensitive information and all. One of the concerns we have is that numbers are provided, statements are made, whether they are reliable, to what extent they really mean protecting the society, larger society, which is now considered as part of the list of stakeholders. Normally we will see stakeholders, okay, we'll start with the customers, we will start with creditors, employees, investors, shareholders. But the point is, the larger society is the stakeholder. Because ultimately we are all working to sell goods or services to the consumers which are forming part of the society. Therefore, any disclosure, any representation must be very fair, which should be verifiable, very fair, and it is verifiable, and where the requirement of assessment comes. As a company secretary, a requirement of the need of the hour is there shall be some vouching, there shall be some kind of assessment which is to be done, which in order to see complaints. That is why I think my friend Manan Lahoti was talking about principle-based system. When you talk about prescriptive regulations, number to be given because that line item will be seen and easily we can put the tick. So principle-based, which is a reputation-building, confidence-building environment and regulations, that will give a larger leadership to the institution which does correct things and reduce the reputation of institutions which do not. So here comes the role of company secretary to ensure that there is zero tolerance to incorrect figures, there is zero tolerance to overstatements, there is zero tolerance to misrepresentations. Thank you.
Thank you. I mean, is there any other suggestion other than impact assessment you're looking at? I'm keen to find out what else can be done to ensure that.
In the beginning, I said about outcome-based approach. This is a very important concept. When we program something to achieve this, what is the outcome? For example, today we do not have any statement to be made on reduce, recycle, reuse. How much is reduced? In what respect? In terms of water, in terms of energy, in terms of emissions, in terms of waste management? How much is done? What is the program? Number one. Study the practices elsewhere, borrow it and apply here.
This kind of approach is the solution, in my opinion, to achieve the result.
Thank you, Ravi. Question is already there before you, Manan.
So, in some sense, and I'm not suggesting this is okay, right? I'm not suggesting that BRSR just becomes tick the box, you copy paste. But if you see any regulation of relevance, it starts with a theoretical exercise. I don't know when was the first time India required audit committees to be part of corporate governance requirements. But initially, it was not that investors will give you value for having an audit committee. It was not creating any value from a financial terms for companies, so they still had to go ahead and do it. And I think most of them maybe started by doing lip service. We need audit committee, so let's make one. Today, you can't IPO a company today without having a very strong audit committee. Forget what the regulation requires. Even if the regulation does not require, you will need one. My point is, markets and companies and businesses do what gives them value. Today, a BRSR is not going to get you higher valuation in the market, is the reason nobody is putting that in the offer document. But it's a good start. If we don't make this start, it will not become the expectation of the market. With rules and rights, they are first given, then they become your expectations. Human rights, 30, 40 years ago, our definitions were different. Today, courts are saying, yes, right of privacy is your right. But it became an expectation before it became a right. At times, the right comes before the expectation. So I'm okay with the sequence in whichever way it follows. But my sense is that today, if you see what the investors need, should become your focal point and make regulations around it. That's one. Second is, the best way to bring in the best practices by encouraging more ESG funds. If you see, capital markets is always transitioning. 50 years back, 40 years back, the only investors in capital markets were people like us, individuals. Then this entire species of insurance funds, mutual funds, foreign portfolio investors came in. Last 5-7 years in India, capital markets is more being driven by local domestic money, which is mutual funds money, less FPIs. You need to empower certain categories of investors to drive the change. Today, we are not so focused on ESG because there are very few ESG funds. They can't dictate terms to an IPO issuer. They can't tell me, if you don't put this, I will not invest. I think we need to focus on creating more ESG funds. And if you see some parts of the world, Scandinavia, for example, the ESG standards expectations are very high because from sovereign fund to private funds, everybody is focused on social impact and environment. We need to encourage ESG funds being created and drive the whole process of capital raising in the market. And I think to some extent, we will be the investors. Today, how many of us call a wealth manager and say, I want to invest in an ESG mutual fund? Very few. There's no tax incentive for it. And your wealth manager says, this is giving you 18% over last 3 years, this will give you 10. Would you still buy? So I think we need to change our mindset, create a new force in the market called ESG funds, and then your BRSR and all will fall in line.
Thanks, Manan. Question is before you. I think you heard both the panelists. Maybe you can add on something more from your own experiences.
Yeah, again, going back to the assessment report of the SES and NSE report, and previously also, I think the starting point, in case there has to be improvement in the reporting, I would really recommend the professionals, that is actually a good bit of document which compares the various parameters vis-a-vis reporting by the different companies. So what I was startled was that, on some parameters, while I won't want to name it specifically, but there is a very disproportionate change from what the figures were reported on the previous year and what has been reported now. So that itself, could be a regulatory concern, or you can say that there has been a less of consistency in the reporting. So it on the all the parameters on environment, social and governance, it nicely compares that how things have over the period performed. So that I would really say the budding professionals who are part of it to see that, because I think that would give a tremendous learning to people who are actually reporting. Other aspect is I would say there are certain inconsistency in the way, like there was a section which mentioned that power consumption for the companies who are in the power industry would be different from who are users. So that I think is a perhaps maybe regulatory intention. Yes, yes, anomaly which would require to be corrected. And then other aspect is whenever your turn is going to get, because there is a staggered way it has to be implemented for the assessment and assurance. So I think one company could be ready in advance of it. When it is going to come, you can get it assessment done in advance. Perhaps that may help, for bringing in improvement.
Thanks, Dinesh. Now I'm going to open the floor for question answers. But I want to do one thing. The Institute of Company Secretary, we have a sustainability board which has been created by the institute, and we have the chairman of the sustainability board seated over here, Mr. Ranjit Pandey. So he's been there for a couple of years now on this 23 and 24 you were there, and again in 25 he is there. So the privilege of raising the first question goes to Mr. Ranjit Pandey, to the panelists over here, being a chairman of the sustainability board of ICSI. Over to you, sir.
Topic is capital market reforms. So my question in regard to the ESG would be that BRSR core and BRSR light is there, and every company is required, listed company of course is required to follow, and they are following wherever it is applicable. And BRSR light is also applicable, but most of the companies are not taking up. So my question is, what is the next course of action to achieve net zero and sustainable economy? And connected question is, in India, do we need some kind of standards also, unified standards, and best of the practices for the reporting, and as well as ESG implementation? So that particular part, whether it should be taken up by the maybe institutions or SEBI or Ministry of Corporate Affairs. That is part one. Part two, Government of India, in fact, Select Committee just now has mentioned that in order to implement the ESG in a better manner, we must have some kind of agency, maybe under the Ministry of Corporate Affairs, and or maybe some independent agency to look after the, say, whole ESG implementation in the country. So what is the view of the panelists on this particularly second part, that what are the recommendation? In fact, Ministry of Corporate Affairs has already responded that these are the things are already in place, and there is no need to have the independent regulator or some kind of implementation agency for this. What is the view of the panelist on this?
Anybody wants to take the question from here? All three? Yeah, go ahead. Shoot.
There are only two things I want to say. I was telling about the greenwashing. So you just look at from that angle, if we are able to capture there is any greenwashing and that is taken care. In India, we have a difficulty. I will tell you this with some sort of confidence. In GE, shareholders brought a resolution to prevail upon the board of directors to bring ESG and sustainability aspects into the boardroom. A resolution was brought to prevail upon the board of directors. Here, there could be anything happening around, regulators will be frowning, taking action, still larger shareholders and investors may not even would have touched the stewardship code. This is one difficulty here. Greenwashing, if it is taken strongly, stern action is taken, it will discipline because they know that this is going to be a regulatory frowning upon such practices. Second, investor preferences and investment direction will shape the practices. Corporate actions are shaped by, in my opinion, these two pillars. Where would the investors want to put their money and where do they want to pull out is going to be a ESG premised one. So if you look at deeply into these two things, we will achieve it. And I am not for a minute any new agency to be created for the purpose of oversight into this. Thank you.
Alan, would you have to share your thoughts on that?
Thank you. So I think where we are going with this, Ranjit, I think we have a framework which is more than adequate. So I don't think we are looking at, do we need to do more? Do we need to be stricter about it? I think that's fine. A smaller point there is inconsistency even in the definition of ESG. Depending on who you ask, the definition changes. But more importantly, globally, the definitions have to be aligned. If I'm a fund sitting out of Scandinavia, I want to invest in India, but only in an ESG compliant, if I can use a term, company, I actually don't think my definition and as a Scandinavian investor and Indian definition is the same. So there has to be a global standardization of it, which will also reduce greenwashing and abuse. The second is, in many ways, if you think about it, if you look at capital markets history, India is still one of the few markets where retail participation is very high. I mean, if you go to UK, I used to work there, so we used to do IPOs without any retail participation. We would actually not sell shares to retail at all. India is different. In spite of India being so different, SEBI has very successfully ensured that bulk of your investments as retail is channelized through mutual funds. And that mutual fund Sahi Hai was a very successful campaign. Not only to build out the entire industry, but to make the capital markets safe for retail investors. We need to do that for ESG funds. We need to go and promote why people in this room should be investing in ESG funds. Today, that force is missing. We have to give market the teeth to enforce regulations are compliant, not the police in that sense. For whether we need independent agency or not, this is a very hot topic which is debated. I mean, ESG is a very hot topic which is debated in every corner of the world. Sometimes you need a regulator because it is not, a topic is not getting enough focus or it's not getting enough compliance. I don't think you can drive compliance just by getting a regulator today. You have to create value for business to comply, whether or not without an independent agency.
Thanks, Manan. I think
Yeah,
one.
so-
Ek minute, let me. I want to make one
Yes.
small submission before you can raise the question. Just one.
Sure.
SEBI also contemplated something when they talked about BRSR, that 75% upstream and downstream should also be compliant. So that, it's not a individual effort. It's going to be a combined effort to reach the objective. But hastily that had to be withdrawn because the companies themselves found it extremely difficult to report about their downstream and upstream. Now, what is your view on that? And how can possibly this can be implemented in the years to come, possibly a few years later? Will that be possible? Because it's not been sensitized across the country, across every person who's there. That is where the problem possibly is coming. So your quick view on that?
Yes, it's a really good point. Downstreaming is where it becomes very tricky because you don't know what your supplier is doing. But if you think about it, say, just take an example of Marks and Spencer or any large retail chain in the US, Walmart. They source from India, they source from China, they source from Vietnam. They ensure that their standards, not only on quality but on compliances, are enforced in the contracts. It takes a while because you're changing the whole ecosystem of another country, or rather another constituent which is so far not regulated. So it will take some time. I think some kind of voluntary guidelines, and then companies reporting on the back of that to actually be able to lead the market. In other words, corporate governance is always about somebody taking the lead and setting the new expectations with pride, and then the others following it. I think somehow, somewhere, we need to set the guidelines and create a path for leaders to emerge. And later on, many more will come, and then you make it mandatory for everybody.
Thanks, Manan. Yes, Ashish,
Yeah,
go ahead.
so my question is related to this ESG bonds and like this what you are talking, like mutual fund sahi hai campaign has created a lot of awareness about the investors, and a lot of investors have come in the mutual fund industry, 75 lakh crore AUM, and regularly it's increasing day by day. But when these ESG bonds are coming, like Surat Municipal Corporation bonds or Indore Municipal Corporation bonds, then retail participation is not there because they are giving some 7 to 8% returns, while equity and other funds are giving 15 to 18%. So retail mindset, because I am also dealing with this mutual fund industry, so they are more concerned about the returns. And when they are comparing the returns, then more safe returns are there in debt funds or the equity funds. Then what is the point should be there, and what should be the campaign when the ESG bonds or these corporate bonds should made popularized amongst the retail investors? Because unless and until retail participation is there, they will not grow to that leap and bounds, because they will give a fixed return, and most of the government organizations are investing in those ESG bonds. So my question is that how to make it popularized, and why retail investors or HNI should invest in those ESG bonds and corporate bonds?
Anybody wants to take that question? Yeah, go ahead.
See, again, you have to understand where India is compared to other countries. India is a growth market. In growth market, everybody sees relevance of investing in equity over safe investments, comparatively safer investments like FDs or bonds. I think 20, 30 years back, I remember everybody thought equity markets is risky. So my parents and all only used to invest in FDs. I told them that no, you can invest in mutual funds, both equity and debt options are available. And they said, it's not as safe as FD, but that's changing. If you go to a UK, US market, their local, not US so much, but UK and the rest of Europe, I would say, their local equities are not doing so well. So people have a natural tendency of being safe investors, and the certainty of income for them is, or their expectation of certainty of income is very different. They're happy to get 3-4% increase year on year on their wealth. In India, everybody wants 12% in 12 months. It's a very, very different mindset. And it's a mindset which has changed. 20 years back, a lot of people were very happy in investing in tax-free bonds. I think everybody used to invest at the end of the year in March in some tax-free bonds. That has gone. And that has not gone for any other reason but one, available of safe equity market and lack of tax incentive. You don't want to make safe equity market unsafe. It's good, it is safe, but you need to create tax incentives, and you have to find retail investors coming in through mutual funds. Retail investors buying and selling municipal bonds is unlikely to happen. SEBI has been working on the corporate bond market, even before the municipal market for retail investors. It's a very tough space to create. They will find it easier to just put money in the FD or in equity mutual fund. So I think you need to find mutual funds giving you that product on the back of tax incentives and again, market awareness, right? Mutual Fund Sahi is a campaign that I keep talking about. It is such a successful one because they actually were very responsible in marketing. They changed the regulations. They were very transparent. Constantly, they are changing the expense ratio. So a lot of things are happening to create the trust. Something we need to do the same for bonds, I feel.
Thank you. Can I ask the other participants if they have any question? Name the panelist from whom you want the answer, so that it saves me a lot of time in terms of asking who wants to reply. Sharda is wanting to have a question. Yeah, go ahead, Sharda.
Good morning. Narasimhan, this is not a question. If it's okay, can I give a suggestion?
Most welcome, go ahead.
Yeah, not
Since
exactly on
in the absence of questions coming from the other participants, we will welcome suggestions as well. Please go
Yeah,
ahead.
so it's not on the capital market, but I was just thinking charity begins at home, and when you're talking of sustainable practices, can the institute itself not look at conducting events in a sustainable manner? We are just having some small gestures as giving a plant or not using a plastic bottle, but we can look at having eco-friendly events and also having an impact assessment report for that. I think institute should look at that. I am telling you out of my own personal experience.
No, we take it in the right spirit. You want to have a different atmosphere from what is happening over here. Maybe we'll have it in the jungle.
No, need not be in the jungle. I'm just giving you a suggestion because my own son's wedding,
My chairman, sustainability board would like to respond to that request of yours or suggestion of yours in terms of what institute is currently doing and what further steps can be taken by the institute to ensure that is adhered to. Okay, over to you.
okay, it's a tough job, but just a suggestion.
Just for the information of the members, in the last ESG and Sustainability Board meeting, we have just echoed these sentiments, and in fact, President Mr. Dhananjay Shukla in the Foundation Day itself has announced that charity begins at the home. And why not we at the ESG and Sustainability Board or at ICSI should have our own ESG policy for first implementable at the ICSI itself. So we have set the targets. We have already hold two such meetings. One is ESG mode meeting and another one is with the all top employees of the ICSI to explore the possibility that where we can implement all the sustainable practices at ICSI, maybe green buildings, maybe green conferences. We have discussed all that green conferences, green buildings, and all buildings should be having the solar panel or water harvesting system, all these things. And reduction of the paper. So all parameters we have discussed, we have fixed. The first target is 2026, then 2027 and 2030. So these three targets, of course it is subject to approval of the council. We have proposed in the ESG board, and this policy, what we are contemplating is that what we are going to implement it for the institution should be implemented and propagated to all other similar institutions so that we should be the leader in implementing it first and propagate others also to follow the same in the time.
Thanks, Ranjit. Thanks, Ranjit. Maybe the next year around, you can possibly have Sharda because she's adept at this subject, and I'm sure she'll be of much greater help to you. Over to the other participants. Any questions from you? Quite a few hands have been raised. One is the last over there. A couple of them. Go hand over the mic. Identify yourself. Name the panelists from you want the response. Please go ahead.
Thank you very much. I think it has been a wonderful discussion so far. I've really enjoyed. Manan, this question is for you. So I'm coming from Mumbai, so I'm a GC of a fintech entity, and we have strategic investments in our company. So my question basically is with respect to when you advise your clients in terms of the expectations what they have from say private equity investment players or strategic players in terms of ESG goals and all in the organization, how they are reaching out a sustainability level. And they are also putting it in the agreements and all, that what kind of sustainable expectations they have. So considering India is a country where we have fragmented BRSR reporting and other structures, but you don't have a specific law per se, say for an unlisted entity. So how do you advise your clients what are the areas they need to kind of look into so that they maintain the balance in terms of the global expectations as well as how they see it from investors' perspective, as you have highlighted a lot on the investor sentiments and also. Just wanted to have your thoughts and how do you advise your clients on that? Thank you.
Thanks. So I'm very aware that there are some development funds internationally who come with what we call as policy rights. They will invest in your company only if you follow the following policies, and they make it a part of the investment agreements itself. It's a fantastic practice. I think the way I would say the new age companies have taken some of these things to a next level is the reason why these conversations have grown so well in the last 20 years. 40, 50 years back when Indian companies were largely held by a business family, some of these conversations were not even relevant because again they were not adding any value. Now getting a large fund, international fund who's known for developmental work is a great look on your cap table. It helps when you do the IPO that somebody with with that reputation was on your cap table. You have complied with their requirements. Your governance standard is already very high. In fact, what we suggest is, and not only we suggest, but the requirement from this fund, even when you IPO, will be to continue this disclosure standard. And your investment agreements fall away at listing, but you can voluntarily adopt them post-listing and continue to report on those lines. It creates, of course, like I said, a premium in the market from a governance standpoint. And if you ask me a question today as to what is the differentiator between two companies which are coming to the IPO, I'll say governance. And I'm not just saying it because it's a thing that people used to always say. In the last 4 or 5 years, the number, ever since some of those, kind of mishaps and unfortunate whatever crashes of companies and their performances, the focus is a lot on G of ESG. So governance itself is beginning to show you better than the others. But also the IPOs that we are seeing today are not necessarily coming from large business families whose reputation was already proven, whether well or not, but everybody knew them. If an IPO came from a Tata or a Birla, you knew where they were coming from. But suddenly now you see 9 out of 10 IPOs are from companies or groups who are not known in the market. The founder may hold 5 or 10% shares, nobody knows them. What will give them the benefit straight away is a governance standard they've been following for years. I'm extending the question a little bit, but in some cases, I advise companies to have independent directors 1 year before the IPO. They're not required to. It's still a private company, not even a public company technically. We say, have a good independent director on the board. It will help you when you market the IPO. So you're in a good position. Just make sure that you keep complying and maybe adopt it even when you don't have to comply under the contract.
Thank you, Manan. I think there are the two other panelists. Manan is the lawyer. If you go to his office, he stops the stopwatch and then talks to you, okay? So, can he have questions for the other two panelists as well? The gentleman over there, somebody raised their hand there. I can't make out. Who is this? Stand up here. Acha. Oh, go ahead. You were. Go ahead.
Hello, I am Ravindra. See, while I laud the actions being taken by the SEBI and also the institute and everything on the sustainability and everything, my question is on the protection of the investor themselves. As rightly pointed out by some of the panelists here, over the past few years, the investments into the mutual funds has gone up like anything, and the lakhs and lakhs of crores are being pouring into the mutual funds. But are there any good quality of the stocks that are available? It is almost, say, what are the valuations in the stock market? It is more than 60, 70, 80% of over the PE ratios. This is how it's coming. And the amount, as per the mutual fund regulations, the amount that is collected by the mutual funds are supposed to be invested, certain percentage has to be invested immediately. And with the result, the availability of the stocks are low, amounts of funds that are coming to mutual funds is very high, and artificially the prices have gone up like anything. And whereas the returns in other like InvITs and REITs and everything is hardly 7%, 8%. So money are not really going into the infrastructure funds or development of the country, but it's going to the some sort of a gamble. As I was seeing one of the videos recently by one of the famous investor, Buffett, he himself says the market has become capital market has become a casino. Now, how to control the overvaluations so that at the end of the day, when the bubble bursts, all the investors will suffer. So how to see that the valuations are perfect and the investors are really protected? what type of action can be taken? Can you please elaborate on that, please? Thank you. Any of the panelists?
Other than Manan, and
Yeah, yeah.
the question should be very brief. I am going to have one last question. Your question over to, you want to answer it? Yeah,
I'll take it.
Dinesh was answering it. Thank you.
Thank you.
One more last question, that's it.
No, I think you, in your question, you mentioned about mutual fund, you mentioned about casino also, you use certain words. So, I think, see, equity investments are obviously subject to risk, that is a given. So, your concern coming from overvaluation, I think your concern is coming from overvaluation. So that I think there have been enough of discussion, whether it is mutual fund managers or investment managers who manage the fund. There has been a lot of discussion, but we have to see that there is one point we miss is there is a significant amount of wealth creation which has happened in the country, which was not the case previously. There is a lot of surplus funds which are there in hands of citizens, and there is a direct participation which is coming. And we also see significant, whatever returns are in past, there is a diversification of the asset classes. Previously, there could be the number of asset classes for investors, they were far less. So when there is a diversification, and this is what the investment advisors also, or the best in class investment managers also advise, that you have to be, your asset class should be divided to, equally into different parts, whether it could be real estate, it could be equity, it could be debt, or whatever other classes are there. Nowadays it has been, gold is also coming up. So in terms of when you are diversified across asset classes, in the long run, things should be okay for the investors.
Thank you. One last question, because I've already received a warning letter from Alka saying that you will not be on the stage in the next program if you don't close it. Please, go ahead. One last question, go ahead. Anybody willing to take it? Okay, 1, 2, 3, close.
Hello.
Go ahead.
Hi, this is Kushani. I'm representing Infosys. And my question is more so to Mr. Manan. I refer to your last answer when it comes to governance. I see that a lot of new age founders of the startups are not very fond of increasing the cost. As you can see, Amazon laying off 30,000 people. So how do you suggest we upgrade ourselves that we don't really become a liability on the company, but more so offer them the cost reduction?
Sorry, I followed the first part of what you said, but you said that the budget that a lot of startup companies have for company secretaries seem less. I think that's the point that you mentioned,
Including
right?
the listed companies.
Including the listed companies.
Yeah.
That's
So how do we
that's a tough one.
navigate the companies to make them understand that the governance is not a choice and it's not a liability? I'm sure we can upgrade ourselves with AI in a domain where we can help them with cost reduction by not employing so many company secretaries as required. But how do we do that? Because this is the future, right? Like the next 10 years for CS is going to be us upgrading to AI.
Yes. No, it's a really good question. I've never thought about this, so my answer is going to be a little bit extempore. So, at least I'll speak about my own conversations. When companies come to me, they come to me 2-3 years before IPO. They say, what do we need to do over the next 3 years to IPO? And one of the first things I say is, do you have a company secretary? Do you have a general counsel? If you don't have, hire one right now. You need one already. You're late. I think, and the way I realize that, those conversations should be done is through VC and private equity funds. They are the people who are writing the first few checks, right? More than even them coming to a law firm, the founders of these startups are going to a VC and saying, give me $2 million, $20 million, $100 million, whatever, give me the check. So I actually went to a lot of VC funds and I said, you should insist in your agreements that they have a company secretary or a general counsel. What I would suggest, if I can, sir, is ICSI should engage with some bodies like IVCA. IVCA is the body for venture capital and private equity investors in India, and explain to them that it is very much in their control that the companies are governed well. And one very important part of governing the companies well is having a company secretary early on. Because one thing that IVCA, I can tell you, is dealing with is a lot of these startups which have gone down in the last 2-3 years. Enough examples have, I don't even want to name names. We all know enough examples. And they're trying to figure how to keep their constituents, which are the investors, funds, VC and private equity funds, safe. I think some engagement, some education through ICA side to IVCA may change the market.
Sure, I have a small counter if I may.
Can you take the question on the sidelines, please?
Sure,
Kindly
sure.
take the question on the sidelines.
Thank you.
Thanks a lot. I hand over the mic to the Premjit for the closing ceremonies.
Thank you, sir. Thank you all for sharing your invaluable expertise and insights and for contributing to such a dynamic, thoughtful, and collaborative discussion throughout this enriching session. Let's give a well-deserved round of applause, ladies and gentlemen. The markets move fast, but sustainability keeps it moving forward. Thank you for this insightful session. A timely reminder that capital market reforms aren't just about returns, but about responsibility. Moving ahead, as a token of gratitude for sparing valuable time and sharing your wisdom, I now request CS Mahesh Atavale, former President ICSI, to please come over to the dais and present a memento to our expert panelist, Sri Manan Lahoti. CS Mahesh Atavale, former President ICSI. Welcome, sir. Thank you. I would now request CS Nagendra D. Rao, former President ICSI, to please come out to the dais and present a memento to our learned panelist, Dr. Dinesh Soni. CS Nagendra D. Rao, former President ICSI. Welcome, sir. Can we have a big round of applause, ladies and gentlemen? And now I call upon CS Vineet Chowdhury, former council member, the ICSI, to please come out to the dais and present a memento to our expert panelist, CS Dr. K.S. Ravichandranji. CS Vineet Chowdhury, former council member. Welcome, sir. Thank you. Here we conclude the proceedings of the second technical session. Over to CS Disha.